Welcome back, and now let's go into market reports, local and international business news for today. Mercury Maritime Concession Company, MMCC, has made significant strides in advancing the 27.29 billion Escravis Deep Seaport Industrial Complex project in Warri, Delta State. Recently, the company announced that it has secured revalidation and approval from the Delta State government, marking a pivotal step towards realizing this ambitious venture. Rear Admiral Okoja, chairman of MMCC, affirmed this development during a press briefing in Apapa, Lagos. He highlighted that alongside the state's revalidation, assurances from the federal government are forthcoming, aiming to finalize the project's earlier provisional approval. This news comes after concerns were raised earlier this month by MMCC about potential delays jeopardizing the substantial investment. The project, set to be situated on 31,000 hectares in Escravis, Baramatu Island, Omadino, within Warri's Southwest Local Government area, has garnered international interest. EDIB International of Hong Kong has expressed keen interest in partnering financially on this expansive port development. Okoja emphasized the project's multifaceted scope, involving cooperation across 8 ministries, including solid minerals, works, marine and blue economy, and power. Addressing regulatory concerns from the Nigerian Port Authority regarding potential monopolies and documentation formalities, Okoja reassured stakeholders that the project adheres to professional standards and is supported by extensive maritime expertise. A director at MMCC, Osbert Udebe, provided insights into the project's deliverables, which encompasses a deep sea port, inland ports across 7 states, and an integrated intermodal transport system for efficient cargo evacuation. Furthermore, the project includes extensive infrastructure development as 45 kilometers of coastal roads, 150 kilometers of rail lines linking to the existing Warri Ajaokuta Itape Railway, and a 600-kilometer marine network. This project also aims to establish robust independent power infrastructure with a total capacity of 2,000 megawatts distributed among IPPs located within inland ports. This comprehensive approach underscores MMCC's commitment to bolstering Nigeria's maritime capabilities while fostering economic growth through strategic infrastructure development. In conclusion, MMCC's progress with securing revalidations and advancing approvals signifies a significant stride towards transforming Escravis into a pivotal hub for maritime activities in West Africa, poised to attract substantial investment and drive regional development for years to come. Federal government announces significant progress in expanding Nigeria's fiber optic network through discussions with development finance institutions, DFIs, to establish a special purpose vehicle, SPV. This initiative aims to add 90,000 kilometers to the nation's existing fiber optic infrastructure, enhancing internet access, particularly in the rural and underserved areas. Minister of Communications and Digital Economy, Bosun Tijani, emphasized the outcomes of a productive meeting where steps were outlined for setting up the SPV. He expressed gratitude to stakeholders for their commitment to advancing the project, which received government approval earlier in the year. The SPV will oversee the project's implementation, financing, and operations, drawing inspiration from successful public-private partnerships like Nigeria Interbank Settlement System, NIBS, and Nigeria Liquefied Natural Gas, NLNG. This move aims to elevate Nigeria's terrestrial fiber optic backbone from 35,000 kilometers to 125,000 kilometers, positioning it as the 3rd longest in Africa after South Africa and Egypt. This project is set to leverage Nigeria's 8 existing submarine cables to bolster the national internet backbone, optimizing connectivity and economic impact. Tijani highlighted collaboration with the World Bank and other partners to ensure the initiative's success, projecting significant GDP growth and inclusion benefits. This project will significantly enhance connectivity nationwide, benefiting millions currently excluded from internet access, Tijani affirmed. The National Broadband Plan 2020 to 2025, a key component of this initiative, prioritizes broadband deployment, 4G expansion, and digital economy policy development. The plan targets minimum data download speed and coverage thresholds by 2025, aiming to reduce internet costs and complexity while fostering broadband adoption. Currently, a significant portion of Nigerians lack regular mobile internet access, prompting policy recommendations to spur infrastructure investment and affordability. In summary, the government's strategic focus on expanding the fiber optic network underscores its commitment to digital transformation and economic growth. By bridging connectivity gaps and implementing robust broadband policies, Nigeria aims to empower its citizens and enhance socio-economic development in the coming years. Federal government has unveiled plans to establish Nigeria as a key player in Africa's terrestrial fiber optic infrastructure, announcing an ambitious initiative to deploy 90,000 kilometers of fiber optic cables across the country. These initiatives, spearheaded by Minister of Finance and Coordinating Minister of the Economy, Mr. Wale Edu, marks a significant leap towards revolutionizing Nigeria's digital connectivity landscape. At the Fiber Forest Strategic Development Workshop organized by the Federal Ministry of Communications, Digital Economy and Information Technology Minister Edu emphasized the transformative potential of this $2 billion Special Purpose Vehicle SPV initiative. This initiative aims not only to expand Nigeria's fiber optic backbone, but also to position the country as the third largest in Africa for terrestrial fiber optic infrastructure upon completion. In a statement released by Mohammed Manga, Director of Information and Public Relations, the workshop was described as a pivotal milestone in Nigeria's journey towards digital empowerment. It highlighted the government's commitment to leveraging technology for economic growth, job creation, and overall technological advancement. Minister Edu reiterated the government's dedication to ensuring the success of the project, which is expected to bridge the digital divide by providing universal access to the internet across Nigeria. The SPV, a dedicated entity for managing the fiber optics project, will oversee its implementation, financing, and operational aspects, drawing governance and operational insights from successful public-private partnerships like NIBS and NNG. Besun Tijani, Minister of Digital Communications, stressed that the project aims to connect at least 50% of the 33 million Nigerians currently without internet access. He highlighted the anticipated economic impact, projecting a potential GDP growth of up to 1.5% capita over the next 4 years. This extensive fiber optic coverage will optimize Nigeria's existing infrastructure, including 8 submarine cables, thereby enhancing data capacity utilization beyond the current 10%, Minister Tijani explained. He further emphasized that enhanced connectivity will facilitate the integration of over 200,000 educational, healthcare, and social institutions into the digital economy, ensuring broader societal benefits from internet access. The initiative aligns with Nigeria's broader digital transformation agenda under the National Broadband Plan 2020 to 2025, aiming to deliver high-speed internet access to urban and rural areas alike. By bolstering digital infrastructure and connectivity, Nigeria aims to accelerate economic development and improve the quality of life for its citizens in the digital age. Mohammed Bello Koko, Managing Director of the Nigerian Port Authority (NPA), has attributed global recognition of Nigeria's economic policies to President Bola Tinubu, citing their positive impact on the maritime industry. In a statement released on Wednesday, Bello Koko highlighted this achievement during an impromptu inspection of the Lagos port access routes recently cleared of a decade-long traffic gridlock by the NPA. He emphasized that Tinubu's policies have not only transformed the maritime sector, but also significantly boosted revenue generation for the NPA. Bello Koko commended Minister of Marine and Blue Economy Adegboyega Oyetola for his leadership in advancing industry reforms. He expressed confidence that maintaining order on port access routes would enhance business operations, drive exports, and improve Nigeria's trade balance. Despite global economic challenges in 2023, Bello Koko noted that the NPA surpassed its previous year's performance. He attributed this success to continuous performance improvement initiatives, which resulted in unprecedented revenue growth from 361 billion naira in 2022 to 501 billion naira in December 2023. Remittances to the Consolidated Revenue Fund also rose from 93.4 billion naira to 131.2 billion naira during the same period. Highlighting additional contributions to government coffers, Bello Koko mentioned tax payments totaling $77.7 million and 17.6 billion naira. Looking ahead to 2024, strategic initiatives include a $1 billion reconstruction project for the Tin Can Island Port Complex and comprehensive rehabilitation plans for the Apapa, Brevas, One, Warri, and Calabar port complexes. In conclusion, Bello Koko underscored the NPA's commitment to sustaining operational excellence, enhancing infrastructure, and fostering economic growth under Tinubu's visionary policies. The ongoing reforms aim to solidify Nigeria's position as a regional maritime hub and bolster its contribution to global trade dynamics. Central Bank of Nigeria, CBN, has announced the discontinuation of its foreign exchange price verification system portal for importers effective July 1, 2024. This decision eliminates the requirement for price verification reports when completing a Form M, which serves as a declaration of intent to import physical goods into Nigeria. The CBN's directive communicated through a circular signed by W.J. Kanya, Acting Director of the Trade and Exchange Department, was addressed to authorized dealer banks and the general public. Initially introduced in August 2023, the price verification portal was made mandatory for all Form M requests, aiming to streamline foreign exchange transactions and monitor imported goods. The system, developed under the tenure of former acting CBN Governor Folashodun Shonubi, integrated e-evaluator and e-invoice technologies introduced in 2022. These advancements aimed to replace traditional hard copy final invoices, enhance documentation processes for foreign exchange transactions, and facilitate the collection of import duties where applicable. The circular titled Discontinuation of the Central Bank of Nigeria Price Verification System Portal cites recent developments in the Nigerian foreign exchange market as the rationale behind this decision. It clarifies that from July 1, 2024, applications for Form M will no longer require a price verification report from the now defunct portal. The announcement ensures clarity for stakeholders, emphasizing that the price verification report is no longer mandatory for Form M submissions. This regulatory change reflects the CBN's strategy adaptation to evolving market conditions, aiming to facilitate smoother import processes and enhance operational efficiency for businesses involved in international trade. Importers and financial institutions are urged to adhere to the updated guidelines, marking a shift in regulatory requirements impacting Nigeria's trade facilitation landscape. The CBN's move signifies its ongoing commitment to refining foreign exchange policies to support economic activities and streamline administrative procedures in line with current market dynamics. In conclusion, the discontinuation of the price verification system portal marks a significant regulatory adjustment by the CBN aimed at optimizing foreign exchange operations and fostering a conducive environment for trade and economic growth in Nigeria. Nigerian Exchange has introduced a cutting-edge digital platform designed to revolutionize the investment process, aiming for seamless accessibility and enhanced user experience. Temi Popular, Group Managing Director of Nigerian Exchange Group PLC, unveiled its initiative during a press conference held in Lagos. He emphasized that the new platform integrates multiple functionalities such as payment gateways, know your customer KYC processes, and brokerage accounts management, paving the way for a streamlined paperless investment journey. Popular expressed enthusiasm about the platform's potential to transform Nigeria's investment landscape, moving away from traditional paper-based methods to a more efficient digital framework. He acknowledged the collaborative efforts with regulatory bodies, particularly the Securities and Exchange Commission (SEC), to ensure compliance and regulatory alignment. Our goal at the Nigerian Stock Exchange is to digitize the entire investment process, eliminating inefficiencies and reducing reconciliation challenges, Popola stated. He highlighted the platform's user-friendly design and its capability to integrate with banking systems for seamless transactions. Real-time KYC verification and simplified brokerage account setup are also pivotal features aimed at attracting both new and existing investors. While awaiting SEC approval, Popola underscored the platform's readiness and confidence in regulatory support. He emphasized the importance of innovation in driving transparency, fairness, and efficiency within Nigeria's financial markets, aligning with broader economic goals set by President Bola Ahmed Tinubu to achieve a $1 trillion economy. Emomotimi Agama, Director General of the SEC, affirmed the Commission's commitment to supporting innovative initiatives that enhance market integrity and investor confidence. He stressed the importance of digital trends to engage Nigeria's youthful population effectively, citing demographic advantage of a predominantly young population. Harun Ajalo Waziri, Managing Director and Chief Executive Officer of the Central Securities Clearing System, CSC, praised the platform's potential to deepen Nigeria's market and contribute positively to economic growth. He highlighted CSC's role in fostering innovation and collaboration to achieve shared market objectives. The partnership between Nigerian Exchange and Meristem Securities underscored efforts to enhance financial inclusion through a USSD platform. This initiative aims to broaden access to the capital market, aligning with national strategies to expand economic participation across diverse demographic segments. In conclusion, the introduction of the digital investment platform by Nigerian Exchange the Nigerian Exchange has introduced a cutting digital platform redesigned to revolutionize the investment process, aiming for seamless accessibility and enhanced user experience. PLC unveiled this initiative during a press conference held in Lagos. He emphasized that the new platform integrates multiple functionalities such as payment gateways, know your customer KYC processes, and brokerage account management, paving the way for a streamlined paperless investment journey. Importers Association of Nigeria has raised alarm over substantial financial losses amounting to over $500 million annually due to challenges such as inconsistent exchange rates and rising operational costs at Nigerian ports. Dr. Basil Nwaolisa, the National Coordinator of Customs, Shipping and Terminal Operations for the association, expressed these concerns in an interview with correspondents in Lagos. Nwaolisa highlighted the drastic increase in clearing costs at ports, citing a rise of up to 300% within a year. He emphasized the severe impact of these factors on importers, noting that the financial burden has crippled many businesses. The country is losing more than $500 billion annually. It should even be more than that. In a month, we are losing about $47 billion, Nwaolisa lamented. He explained the compounding effects of high demurrage fees, which currently stand at 60,000 naira per container per month. This adds significant financial strain to importers, making it increasingly difficult for them to sustain operations and remain competitive in the market. Furthermore, Nwaolisa criticized inconsistency in forex policies, pointing out that exchange rate fluctuations from procurement to duty payment exacerbate inflationary pressures and operational uncertainties for importers. He underscored that these challenges have resulted in a dire situation which many importers have halted operations, leading to potential future inflationary impact on the economy. while Lisa called on the government to engage stakeholders more effectively before implementing new policies, suggesting that adequate consultation and transitional periods are crucial for businesses to adjust to regulatory changes without severe disruptions. Echoing these concerns, Mr. Kayode Farinto, former Vice President of the Association of Nigerian Licensed Customs Agents, affirmed the significant adverse effects of the forex crisis on importers. While unable to quantify the exact losses, Farinto corroborated the assertions made by Walisa, emphasizing the widespread impacts on import-dependent sectors of the Nigerian economy. In conclusion, the statement from industry experts paint a bleak picture of the challenge faced by importers created by forex instability and high operational costs. The call for more inclusive policy-making processes and strategic interventions underscores the urgent need for sustainable solutions to safeguard economic stability and support import-dependent sectors in Nigeria. Consolidated Hallmark Holdings PLC has reported a substantial growth in its financial performance for the year 2023, showcasing a robust 32% increase in revenue to 15.7 billion naira in 2022. This announcement was made by the chairman Abubakar Idris during the annual general meeting held in Lagos. Despite the challenging economic conditions, the company demonstrated resilience milestones across various financial indicators. In addition to the impressive revenue growth, Consolidated Holdings also saw a remarkable 44% surge in total assets, which climbed to 26.2 billion naira from 18.2 billion naira. Profit before tax soared to 4.6 billion naira compared to 983 million naira in the previous year, marking a substantial increase. The total profit attributable to shareholders the year 2023 stood at 3.8 billion naira, a substantial increase from 547 million naira recorded in 2022. Highlighting the company's commitment to delivering value to shareholders, Chairman Abubakar Idris reaffirmed their dedication to providing consistent returns on investments through dividends. He proposed a dividend payout of 5 kobo per ordinary share of 50 kobo, amounting to a total dividend payout of 542 million naira. Looking ahead, Idris expressed optimism about a more favorable operating environment in the coming years. He outlined plans to leverage this environment to enhance the market share of consolidated Hallmark Holdings across all sectors where they operate. Emphasizing the role of technology, he reiterated their strategy to consolidate operations and strengthen their position as a key player in the financial services sector and beyond. The Group Chief Executive Officer, Mr. Eddie Efekoha, emphasized that one of the company's core strategies is the prompt payment of fully documented claims. This commitment not only enhances customer satisfaction, but also reinforces Consolidated Hallmark Holdings' reputation for reliability and efficiency in the insurance sector. Overall, Consolidated Hallmark Holdings' financial results for 2023 underscored its resilience, strategic foresight, and commitment to sustainable growth. The positive outlook and proactive strategies outlined by its leadership positioned the company well for continued success and value creation for shareholders in the future. Nigerian equity markets rebounded on Wednesday, recovering from previous losses with a substantial gain of 94.95 billion naira. The positive momentum was driven by notable increases in shares of cocoa processors, O&O, Computer Warehouse Group, and 32 other stocks. As a result, the market's capitalization rose by 0.2% to reach 56.22 trillion naira, while the all-share index closed at 99,385.44 points, reflecting an uptick in investor confidence. Year-to-date returns also saw an improvement, climbing from 32.7% to 32.9%, underscoring the market's resilience and attractiveness to investors. Bullish activity was evident throughout the trading session, with 35 gainers outperforming 13 losers. Leading the gainers were FTN, Cocoa Processors, O&O and Computer Warehouse Group each recorded a notable 10% increase in their stock prices to 1 naira 54 kobo and 13 naira 75 kobo and 6 naira 60 kobo respectively. Conversely, Secure Electronic Technology, Cornerstone Insurance Company and Royal Exchange were among the top losers, facing declines of 10%, 8.64% and 7.58% respectively. Trading volume was led by Access Holdings with 45.33 million shares traded, followed by ICO Insurance and Guaranty Trust Bank with 23.96 million and 13.85 million shares respectively. Despite the positive sentiment, trading activity moderated slightly with both volume and value traded decreasing by 23.6% and 33.2% to 276.4 million units and 4.1 trillion naira respectively. Sector performance was largely upbeat with gains recorded in the banking and consumer goods indices rising by 0.8% and 0.3% respectively. This was fueled by price increases in stocks such as FBN Holdings, Zenith Bank, Unilever and Dangote Sugar. Looking ahead, analysts at AfriInvest anticipate that the positive market sentiment will persist, supported by improved investor confidence and sustained bullish activities across various sectors. You're watching Atn Business on Atlantic Television Network. We will be back after this break. Just stay tuned.
Every day, our lives are changed by history.
We are one people, all of us.
Leaders, politics.
Nobody's ambition is what the blood.
I have fought very firmly.
Natural occurrence, war, and the world economy.
I belong to everybody, and I belong to nobody.
ATN coverage on ATN Politics today.
People into the country illegally. That is amazing.
Honourable
You human trafficker.
They are not picking our calls. They made up their minds.
So no agreement with the EU, but
Welcome back to Atn Business on Atlantic Television Network. Now to the rest of our stories. Global markets experienced a downturn on Thursday in anticipation of the upcoming U.S. inflation report, which could signal future changes in interest rates. Hong Kong led the losses with a decline of over 2%, setting a negative tone echoed by U.S. futures, while oil prices showed signs of recovery. In early European trading, the CAC 40 in Paris slipped 0.2% to 7,593.97, and London's FTSE 100 fell 0.1% to 8,215.80. Germany's DAX was the exception in inching up less than 0.1% to 18,162.74. Meanwhile, S&P 500 and Dow Jones futures were down by 0.2%, emphasizing cautious sentiment ahead of critical economic data. This week's focal point is the U.S. government's release of the Personal Consumption Expenditures PCE Index on Friday, the Federal Reserve's preferred measure of inflation. Analysts noted investor hesitation followed mixed economic signals, with particular attention on how inflation data might influence the Fed's decision on interest rates. The ongoing impact of higher rates globally underscores the significance of upcoming U.S. economic indicators. In Asia, efforts to stimulate the Chinese property market failed to boost investor confidence. Hong Kong's Hang Seng declined 2.1%, while the Shanghai Composite dropped 0.9% as Beijing implemented new measures to ease mortgage restrictions. Similar efforts in other Chinese cities aim to rejuvenate a market reeling from government crackdowns and developer defaults impacting the broader economy. In Tokyo, the Nikkei 225 fell 0.8% to 39,341.54 amidst concerns over yen depreciation against the dollar, prompting warnings of potential market interventions by Japanese officials. Elsewhere, Australia's S&P ASX 200 slipped 0.3%, Taiwan's TAIEX lost 0.4%, and Bangkok's SETs retreated 0.5%, though Mumbai, Jakarta, and Singapore saw modest gains. On Wall Street, despite subdued trading, major indices hovered near record highs set the previous week. The S&P 500 edged up 0.2%, with significant contributions from individual stocks offsetting broader market declines. Amazon's 3.9% rise pushed its market value above $2 trillion, complemented by FedEx's 15.5% gain following robust quarterly results. Rivian surged 23.2% on news of Volkswagen's substantial investment, while Apple and Microsoft made modest gains, underscoring their influential roles in market direction. Investors are closely monitoring the Federal Reserve's stance on interest rates, anticipating potential cuts starting as early as September to elevate economic pressures without jeopardizing inflation targets. Despite persistent inflation challenges and high borrowing costs, the economy remains resilient, albeit showing signs of slowing growth. The balancing act for the Fed lies in timing rate cuts effectively to support economic momentum while managing inflation expectations. In commodities, U.S. crude oil rose 68 cents to $81.58 per barrel, and Brent crude climbed 72 cents to $85.19 per barrel, reflecting market dynamics amid economic uncertainties. The euro also saw a marginal increase against the dollar, highlighting ongoing currency market movements amidst broader economic trends. Bank of England highlights significant areas for improvement in risk management within the private equity sector, particularly as prolonged low interest rates escalate financing costs in this heavily leveraged industry. In its biannual financial stability report released on Thursday, the bank underscored the need for enhanced transparency in valuation practices and reductions in overall leverage to mitigate vulnerabilities. According to the reports, increased transparency regarding valuation practices and a clear of leverage levels would bolster sector resilience. The bank emphasized that risk management practices across various segments of the private equity sector, including among its lenders such as banks, require enhancement to navigate the challenges posed by rising borrowing costs. The Financial Policy Committee (FPC) announced its intent to review ongoing internal efforts alongside initiatives led by the Financial Conduct Authority aimed at addressing these issues comprehensively. This collaborative approach aims to fortify the sector's risk management framework and ensure its resilience amidst economic uncertainties. Addressing concerns over the valuation of Britain's banking sector relative to international peers, the report noted that British banks' equity valuations align closely with the Eurozone counterparts and are narrowing the gap with U.S. peers. The differences observed were attributed to broader market dynamics, economic outlooks, and the market's depth in the respective regions. Looking ahead, the Bank of England disclosed plans to conduct a desk-based stress test of major UK banks using internal models, with aggregate results expected in the fourth quarter of this year. This approach, distinct from traditional data-driven stress tests, aims to assess the banking sector's readiness to withstand adverse economic scenarios independently. The report also outlined initial findings from its system-wide exploratory scenarios series, which examined theoretical shocks impacting various market participants, particularly the UK government bond market. Initial results indicated increased liquidity needs and heightened selling pressures in corporate bonds following stress scenarios. Notably, liquidity buffers among market participants have exceeded regulatory minimums since the near meltdown in the UK government bond market in September 2022. Looking forward, the Bank of England plans to continue monitoring and refining its stress testing frameworks through subsequent phases of the series, with comprehensive results anticipated in the fourth quarter. This strategic approach aims to enhance market stability and reinforce the resilience of the financial system against future uncertainties. Crypto firms are rapidly becoming focal points in the realm of business deals, driven by the burgeoning demand for artificial intelligence (AI) capabilities. Bitcoin mining companies known for their expansive data centers and robust infrastructure across the United States are finding themselves at the intersection of crypto mining and AI. These mining facilities, equipped with high-capacity compute capabilities, fiber optic connectivity, and substantial power resources, are ideally suited for the compute-intensive operations required in AI development. As the profitability of generating new tokens decreased significantly following the Bitcoin halving event in April, miners are increasingly exploring new avenues to diversify their operations and maximize returns on their substantial investment. According to analysts at JPMorgan Chase, the recent halving event has slashed industry revenues, prompting many operators to consider strategic exits or alternative growth strategies. This financial pressure has accelerated the pace of mergers, financings, and partnerships within the crypto sector, particularly focusing on AI integration. A notable recent development is the expanded partnership between US-based Bitcoin miner Core Scientific and CoreWeave, a startup backed by NVIDIA specializing in AI technology. Core Scientific announced plans to provide 70 megawatts of computing infrastructure to support CoreWeave's AI operations, with projections indicating potential revenues of $1.2 billion over 12 years, in addition to existing revenue streams totaling $3.5 billion. By mid-2025, Core Scientific aims to deploy approximately 270 megawatts of infrastructure to CoreWeave, with potential expansions to an additional 230 megawatts across other sites. In a bold move indicative of the sector's dynamism, CoreWeave recently proposed to acquire Core Scientific for $1.02 billion, underscoring the strategic value placed on robust data center capabilities amid the AI boom. Despite Core Scientific's rejection of the bid, the company's market valuation remains strong at approximately $1.8 billion, reflecting its pivotal role in the evolving landscape of digital infrastructure. Elsewhere, Miami-based Bitcoin mining group Atn secured $150 million in debt financing from private equity firm Couture to bolster its AI-focused data center expansion. Atn, which has already begun integrating NVIDIA GPUs into its operation, reported that 6% of its sales derive from AI-related activities. The company's strategic pivot towards AI includes commercial agreements under a GPU-as-a-service model, emphasizing fixed infrastructure payments and revenue-sharing arrangements with AI cloud platforms. As these developments unfold, industry leaders like Core Scientific and Atn are reshaping the narrative around crypto mining, positioning themselves not just as cryptocurrency producers, but as essential infrastructure providers powering the AI-driven future. With AI's demand for robust computing facilities set to grow exponentially, the convergence of crypto mining and artificial intelligence represent a pivotal evolution in digital infrastructure strategy and investment. According to an analysis from the U.S. Energy Information Administration EAI released on Wednesday, U.S. energy production in 2023 outpaced consumption by the largest margin on record since 1949, exceeding it by 9 quadrillion British thermal units. The report highlighted that U.S. energy production reached a new peak of nearly 103 quads in 2023, marking a 4% increase from the previous year. This growth was primarily driven by significant expansions in natural gas and crude oil production. Despite the Biden administration's efforts to decarbonize the economy, the oil and gas industry in the U.S. saw notable gains. Dry natural gas production increased by 4% in 2023, demonstrating a substantial 58% rise since 2013. Similarly, crude oil production surged by 9% from the previous year and has shown a remarkable 69% increase since 2013. Renewable energy production also saw an uptick, rising by 1% to reach 8 quads in total for 2023. This growth reflected a 28% increase since 2013. Solar energy production notably expanded by 15% during the year, while wind production experienced a slight decrease of 2%. Conversely, U.S. energy consumption slightly decreased in 2023, with petroleum and natural gas consumption remaining largely unchanged from 2022 levels. Coal consumption, however, witnessed a significant decline of 17%, reaching its lowest level in over a century, primarily due to its diminishing role in electricity generation. Chris Higginbotham, spokesperson for the EIA, attributed the ongoing increase in natural gas production to its status as a byproduct of crude oil extraction, particularly in regions like the Permian Basin, which accounts for nearly half of U.S. crude oil production. He also cited 2 key factors contributing to the decline in coal consumption: the retirement of coal-fired power plants and the economic competitiveness of natural gas, bolstered by low prices alongside expanded renewable energy capacities. Overall, the latest EIA analysis underscores the resilience of the U.S. energy sector amidst evolving policy landscapes and economic dynamics, highlighting robust growth in production driven by natural gas and crude oil, alongside ongoing shifts towards renewable energy sources. China's Commerce Ministry expressed optimism on Thursday that negotiations with the European Union and EU could yield a mutually acceptable solution regarding the impending tariffs on Chinese electric vehicles (EVs) set to commence on July 4th. State media reports from Beijing indicated a desire for the EU to abandon its plans for imposing these tariffs, while Brussels emphasized the need for China to present a clear strategy during ongoing technical discussions this week. The EU has stipulated that for negotiations to proceed positively, China must outline a roadmap to address concerns regarding what Brussels views as injurious subsidization within China's EV industry. China has consistently refuted allegations of unfair subsidies, asserting that the growth of its EV sector stems from technological advancements and robust market and industrial supply chains. He Yadong, a spokesperson for China's Commerce Ministry, affirmed ongoing dialogue and and intensified consultations between the working teams of both sides. He emphasized the importance of both the EU and China aligning their efforts towards a mutually beneficial outcome, aiming to prevent further escalation of trade tensions that could adversely impact economic and trade relations between the two. Furthermore, the Commerce Ministry disclosed that it had received and was currently reviewing submissions on behalf of China's electronics industry concerning an EU investigation into trade barriers. This process underscores China's proactive engagement in addressing regulatory concerns and fostering a cooperative approach with the EU. The developments reflect a crucial phase in China-EU economic relations, with both parties striving to find common ground amidst complex trade dynamics. The outcome of ongoing negotiations will likely influence the trajectory of EV trade between China and the EU, shaping future policies and bilateral economic interactions in the global market. As discussions continue, stakeholders await further updates on whether consensus can be reached to mitigate potential trade frictions and promote sustainable trade practices between these economic giants. This is why we wrap it up on this edition of Atn Business on Atlantic Television Network in the city of Port Harcourt. I am Susan Abbey. We are open for advert placements, bookings, and commercials. Stay connected on ATN socials, Facebook and YouTube, Atlantic Television, Atlantic TV Network 1, X, formerly Twitter, Atlantic TV Net. You can also watch us live on our website, atlanticnetwork.tv. Peace and unity are the pathways to progress. Thank you for watching.